Hi, I'm Pattu from FreeFinCal. A couple of days ago, I had talked about the simple secret behind equity investing. Let's see a dramatic example of this. The Sensex is about 41.5 years old, and the since inception returns for the Sensex are more than 16%. I say more than 16% because the actual total returns index, that is inclusive of dividends data, is not available since inception. The since inception price return, annualized price return, is about 14.6% or so up to date, and if you add about 2 to 2.5% of dividends on top of that, it will easily be more than 16% for over the last 41 years. But what is astonishing, extraordinary, and perhaps a little disappointing is that half of those returns, more than half of those returns, came from just 3 good years. This data that I'm going to show you in this video, and what has been analyzed in this article published today morning, is a study that I had already done about 7 years ago in June 2013. I think it's called Understanding the Nature of Stock Market Returns. I've just added a little bit more information to it, a little bit more context to it, and also I have got some experience over the last 7 years on how to present data. It's not about the analysis, it's not about the result, it's about how you actually make it presentable. All right, so let's get to these numbers. You can read the article. I don't want to show you those numbers there, it's harder to see. So what I have done is I have taken the Sensex and I have shown the annual return. So for example, on the 3rd of April 1979, the Sensex was 124.15. That's the earliest data point that's available in the BSE. They don't have data from 100, which I find amusing. The actual trading in the Sensex only started in 1986. So this data from 79 to 86 is basically some kind of a back calculated data. It doesn't represent true market supply and demand in action, but that's okay for our purposes. So I have taken these annual returns. So for example, from 3rd April 79 to 1st April 1980, the return was 3.5%. From 1st April 1980 to 1st April 81, it's 35.25%, and so on and so on and so on. And we have the top 5 or 6 returns which you can get from this list. In case you did not know, Excel has got a very interesting function called large. So you can simply say large of this return set comma 1, then it will give you the maximum. Then if you say large of that return set comma 2, then it will give you the second highest, comma 3 third highest, and so on. Similar to large, then it has got a command called, if I remember right, it's called small. Then it gives you the smallest, the one before that, and so on. So in addition to this maximum and minimum return functions, you can also use this to find out the second highest, third highest, the lowest, the one above that, and so on and so on. So that's what I've done. I found out the first 5 returns, and the highest return is 267.61%. This came because of the Harshad Mehta scam. That was the return as on the 2nd of April 1992. Then the second highest is about 86% return, 1st April 2004. That was the start of the big bull run in the early 2000s. And then the third is 82% return that came in the 3rd of April 1989. I'm not sure what is the reason for this. I don't think the Harshad Mehta the scam was active around this period. It was just after that period, but I'm not sure. I don't know the reason for this 82% return between April 88 to April 89. Then the fourth highest is 78.6% return. That 78.6% is for first as on 1st April 2010. That's the recovery from the 2008 crash. And the next is 75% return. That's in April 2006, again part of the bull run. So those are the top 5 returns. And if you notice, this 82% return, before that the return was minus 22%. So it's more of a recovery. There's one more return, the sixth highest, which is 63%, which is a recovery from the Harshad Mehta scam to some extent. The previous return was minus 47%. Then this 86%, the previous returns were minus 11%, minus 1%, minus 29%. 3 years, 2001, 2002, 2003, 3 years of poor returns. Then that is the period when the PP of interest rates dramatically dropped from 12% to about 9% in very quick succession. That was the that triggered that big bull run in the early 2000s. 75% was just in 2006. The 86% return was in 2004. The 2010 78% return came as a recovery from the 2008 stock market return. So the point I want to make here is, except the Harshad Mehta scam, which is the 267% return, pretty much every other return was basically a recovery. The previous returns were very large negative numbers, or something like that over a few years, last few years, and then there was a recovery by this huge return. If a person had got scared of the stock market, seeing this minus 29% return, minus 1%, minus 11%, and exited the stock market, they would have missed out on these big returns, except the Harshad Mehta 267% return. They would have missed out on these huge returns, and that is the single most important lesson that you have to understand from this. And you can see the since inception, that is the CAGR from 3rd April 79 all the way to 1st April 2020 is about 14.6%. Now I'm going to start removing numbers from it. So remove the topmost return, and it will drop from 14 to 10. Remove the second highest, which is 86, then it will go to about 8.9. Remove the third, and then it will become 7.34. So you can imagine more than half the returns have come from just these three. And if you remove all the top 5 returns, then you will be able to get a return of only 3.5% after 41 years. So that is what I have been saying for a long time. Stock market returns are extremely clumped. They will suddenly give you huge returns, and they will suddenly give you huge losses, or there could be no returns for a long time. Whatever it is, if you want to make money from the stock market, you must stay invested through these huge 70%, 80% kind of annual returns. If you stay invested through this, your life will change. But you should not be greedy and leave the money there. You should look at your financial goal. You should look at your asset allocation. You should do a rebalancing, safeguard that safeguard part of the money to put it in a safe asset like PPF or something which is relatively safer. But please recognize, some people do not appreciate this still. There is no such thing as profit booking in equity. Although people talk about profit booking in stock market and so on, you cannot differentiate between the principal and the profit, that is the gain. You can't differentiate it. It's all about first in, first out. That is, you buy 10 stocks on one day, you buy 20 stocks 1 month later. When you sell, it is those first 10 stocks which you are going to give it back to the market and get back the corresponding money. First in, first out. So that's the same for mutual fund units as well. So always the money that you are going to get when you make a redemption will always contain part of your principal, and part of it will be your capital gain. You can't differentiate these two. So when you say take away the profit, you can't simply take away just the profit alone. That's not possible at all from the stock market. Of course, it's all mental accounting. Mentally, you will say that's all right. I put 100 rupees. I have removed 100 rupees now. So 100 rupees is the gain. The value was 200 rupees. I removed 100 rupees. Mentally, it's a matter of mental accounting. It's fine. But you must understand, as a technicality, there's no such thing as profit booking in the stock market. But that's the whole essence. So don't get scared by this. Of course, it's very disillusioning, disappointing to see that one single 267% return is responsible for that 15% return from stock market kind of propaganda that is used to sell mutual funds. Everything is riding on the basis of a scam. And if you notice, because of the scam, In 91, the return was 52%. In 92, the return was 267%. But when the scam broke, the return was minus 47%, and the next year it recovered back to 63%. The year after that, it was minus 12%, and so on. So there is a even because of the scam, the many of the securities increased, but they did not fall proportionally. If they increased by 100%, they only fell down by about 50 or 60% or so, about 40 to 50% or so. So that is the whole what they call as the stock market return skew. That is, the returns in the stock market are skewed towards the positive side because people. It's all about trust. Stock market returns comes from trust, and when people don't want to completely lose trust in the system. They want to get back into the system as much as possible. Even if there's something wrong, they want to quickly put back the money, and somehow, even with printed money, they want to get the system going. That's what happened in 2008. So because of this kind of collective trust, although it is not based on any kind of logic, in fact, it is some collective trust that keeps the stock market going, and there's no other way to profit from it other than to face some losses and wait for those gains. Of course, you can say I will time the market and so on. Yes, timing the market is possible, but you can't time the market to say I will avoid that minus 22% return and I will get only that 86% return. That's not going to happen ever. When you time the market, you will reduce the losses and you will also reduce the gains. There is no other way to do it. Anybody who says any other thing is possible, they are just going to they are a cheat, or they are just ignorant, because there are many people who are ignorant. They'll say, oh, that doesn't look right, those numbers you have projected does not look right to me. I don't give a rat's fart whether they look right to you or not. I have done the numbers. You do the analysis and then we can talk. So please recognize that you can time the market, but if you time the market, you are always going to basically reduce the losses, and when you reduce the losses, you are also going to reduce the gains as well. It is like trimming a bush. When you trim a bush, sometimes the flowers also will get cut. So don't get scared by this. This is the market. You will have to pull through this period of poor returns. Stay invested, keep investing as much as possible. And please recognize, don't think about 15% return, 12% return and so on. Don't get fixated with return numbers. Focus on the goal amount, the corpus. What is the corpus you want, and where are you today, and how much should I rebalance my portfolio into safer assets when I get those huge gains, or rebalance when I get poor returns in equity. I can rebalance and put money into equity as well. That's also possible. How can I do it so that my goal will get benefited? When I'm talking about money here, I want 1 crore after 2 years or 5 years or 15 years. How can I get that 1 crore? It doesn't matter whether I end up with a 2% return or 15% return. Finally, I need 1 crore. That's what is going to be the that's going to pay your bills. Returns are not going to pay your bills. So catch you later. Bye bye.